Hello everyone, thanks for joining us. Today is part of a series of videos that we're looking to do, and we're going to be interviewing a number of people within the world of finance and the fund management industry, and also we're going to be going around the country looking at interviewing people from the SME market across the UK. Today I'm joined by a very interesting character called Chris Ralph. He's the global strategist for St James's Place and was formerly the Chief Investment Officer. Good morning, Chris.
Good morning, David. Delighted to be with you.
Thank you very much for joining us. It makes a change, doesn't it, to be sat in front of each other?
It does indeed, yes.
having a chat. So, just in general, how has lockdown been for you in terms of your current role?
Well, I changed my role in that I handed on the baton for being the Chief Investment Officer at St James's Place at the end of the year and moved into a new role as Chief Global Strategist. And what that's allowed me to do is focus a bit more of my time on what's going on in markets, how economies have been adapting, and who'd have thought at the beginning of the year we'd be in a situation where there'd been the biggest correction in the global economy that has pretty much been on record, and how the markets have been recovering from the pandemic. So it's been a fascinating year to change my role.
So in the current environment then, just coming back onto the actual area that obviously you and I work within, which is fund management, what do you see fund managers doing differently that they weren't doing during lockdown?
Well, I think there's two parts to that, David. The first part is that clearly they're not able to travel, and a lot of fund managers travel on a very regular basis. And during the pandemic, they've been stuck at home or at best going into the office on an irregular basis. And that's meant that they've not been able to interact with company management in the areas in which they work, not being able to see the shop floors, not being able to meet junior employees. At the same time, if one looks at it in terms of the implementation of philosophy and process, we didn't want to see any change from our fund managers, and generally we haven't seen change. They've been undertaking their investment activities in the way that we would have expected them to be doing, thinking very carefully, objectively, dispassionately about where the investment opportunity lies, rather than being distracted by the news on the pandemic or what's happening in the global economy.
Okay, thanks for that, Chris. I mean, how much of an impact, though, do you think that the pandemic will have on longer-term fund performance? Obviously, a lot of people actually probably watching this video right now will remember the 2008 crash. So how does it compare what we're currently seeing now, and how do you think that's going to play out going forward compared to the recovery we had in 2009?
I think the global financial crisis was quite different, mainly because the response from the authorities, governments and central banks was different in that instance. What we tended to see as a result of the global financial crisis was a mix of monetary stimulus, so quantitative easing, which is a term that we've all got used to over the last decade, but also generally austerity, so a retrenchment in government spending. What we've seen this time around is very different in that we've seen huge monetary stimulus, but also huge fiscal stimulus. Governments have been spending money hand over fist. And what that means is that the government, as part of the global economy, has got bigger. If one looks back in history, at times when governments have been bigger in the global economy, it tends to equate to lower returns for asset markets, probably because governments are thought to allocate funds inefficiently, and therefore economies are not as efficient as they would be if they were just being run by the private sector. And therefore, I think it would not be hard to imagine lower global growth and therefore lower market returns. Having said all of that, do I believe that the basic paradigm of saying that equities will beat bonds and that bonds will beat cash still exists today? Absolutely it does, and to some extent it's probably reinforced by the level at which bond markets have got to over recent time, and the terribly low, if not negative, returns one's getting on cash today and probably for the foreseeable future.
Absolutely. So just with regards to the impact of the pandemic on long-term performance, and also looking at the medium term with regards to bonds and whether they will hold their value, what's your views on that? And also with the government borrowing being so high, are gilts worth punt in the current market, or?
Well, I don't think any asset class is ever worth a punt when one's thinking about investors' wealth. I think the challenge that governments have got is that they've got huge funding requirements going forward, bigger than they've been probably since the Second World War. And therefore, it's really important for them to try and have relatively low yields, i.e. the interest payments they've got to make on those on that government borrowing. They want to keep that relatively low because it means the funding requirements for them will continue to be low. Having said that, if there is a perception that the quality of government finances is decreasing, then investors are not going to want to own those bonds, yields will go up, and that will mean that the refinancing will be more expensive. So I'm inclined to think that for a government bond portfolio, one is not likely to see great returns going forward over the next period of time. We've had a 35-year bull market in government bonds, and we may be near the end of that. Having said that, if one looks at corporate bonds, so bonds issued by companies, I still think that in general they will deliver a better return than government bonds, and as part of a diversified portfolio may be exactly where clients should be thinking about making allocations to.
Okay, brilliant. Thanks for that, Chris. What we've seen recently, obviously, is markets having bounced back fairly considerably. And obviously, there's a lot of commentators saying that they feel that some of these values now are slightly overpriced. Obviously, we've got a long road ahead of us in terms of recovery, quite potentially. And obviously, we've got a drop in company earnings and possibly an inflation of unemployment figures. So how do you think that should all play out? And obviously, are we looking like, there's going to be a consistently long recession? Or how do you see that playing out?
Yeah, well, actually, I think to answer the first part of or the last part of your question first, the recession is probably going to be the shortest there's been maybe on record. The bounce back has been very, very sharp. Not quite being V-shaped as some commentators suggested it might be, but it's been very, very quick. I think what's been fascinating, if you look at the impact on markets, is that if you exclude the performance of the technology sector or the so-called FANGs, and you've probably got to include companies like Tesla in that as well, the rest of the markets have not done particularly well. Yes, they've bounced back a reasonable amount from their March lows, but they're still, if you look at it in FTSE 100 terms, about 1,500 points lower than they were at the time of their peak. So valuations in a lot of UK shares are still relatively attractive. Similarly in European shares. If you look at the US market, the S&P 500 has got to all-time highs, it's got above all-time highs, yet nearly 2/3 of companies are still at lower levels in terms of price than they were back in February when the previous high was met. So it's not been a uniform performance. So what that means for a portfolio manager is there's still plenty of ripe opportunity for finding companies that are misvalued, that they think they can deliver great returns from over the medium to longer term, and that's what we want our fund managers to be doing. So it's really been very concentrated in that smaller area. And whilst earnings have been hit, clearly there's a gap in earnings in the second quarter. The bounce back could be quite sharp, and I think we're hearing more optimism from companies than could have been expected if one winds the clock back to March or April, for example.
Thanks very much for that, Chris. Just with regards to your thoughts on, we get a lot of questions from clients, obviously, about China and the Far Eastern markets, and actually there's also a consensus that some people are saying that the US market's overvalued at the moment. So if you could sort of start by just giving your thoughts on the China and Asia Pacific area and what you think about that going forward.
I do think China is very interesting. I was interviewing an emerging market bond manager yesterday, and she was saying to me that she still sees enormous opportunity in China going forward as capital markets continue to develop in that area. And I think Chinese equities as a proportion of the global indices will only increase over the next, say, 10, 20 years. The growth rates of the Chinese economy are most likely going to be superior to growth rates in the so-called developed markets of the US, Europe and the UK. And there is an acceleration of the number of people that are coming out of poverty in China into the middle classes, an acceleration in the domestication of the Chinese economy, so it's more inward focused and therefore less reliant on exports, which it was, for example, pre the global financial crisis. Yes. And its quality of manufacturing is much, much superior than it has ever been before. So China, yes, it has got problems. It's not a perfect system, and I'm sure there are a lot of criticisms of the political regime that people would level against it. But in terms of economic progress, it's likely to continue to be right at the top of the leaderboard. And that will follow through to other Asian economies as well, some more so than others. So obvious areas like Singapore, for example, is already relatively developed. But if you look at an economy like Vietnam, or even some of the really small economies like Cambodia or Laos, you know, they are economies that could do really well, sort of piggybacking off the growth that one's seeing in China. And if you compare that to the United States, where the economic progress of the United States is probably reaching the peak of its position in terms of global power, and there's a lot of debate about whether there is a transference of power from the United States to China. I think it would be relatively easy to postulate that the next period of time will be China and Asia's period of economic growth, as opposed to that of the United States, which we've been familiar with for, I suppose, pretty much the last 100 years. So yes, that transfer of power will be relatively significant, and therefore we look for our fund managers to say, well, how can they take advantage of that in portfolios? Is there maybe Chinese equities they could take advantage of where the growth is happening, or indeed companies that undertake a lot of business with China and other countries in Asia where they may be able to gain exposure to. So lots of opportunity there, but I think it comes back to Asia being the fastest growth area in the world.
Okay, thank you. You mentioned earlier, Chris, that you brought up the subject of FANG stocks.
Yes.
Just on the future of FANGs, where do you see they'll be going? Obviously, we've seen recently in the news during lockdown that Apple's now progressed to be in the value it is, which is larger than the value of the FTSE 100 companies combined. Where do you see those stocks going forward in the future?
Well, again, I think there's a couple of different aspects to that. There's sort of the fundamentals of technology and the development of companies like that, like Apple or Facebook or Google, the FANGs as we call them. And it seems that the pandemic has demonstrated that the opportunity that those sort of companies have is really quite exciting. That Amazon, for example, has been able to deliver and benefit from the pandemic, even in a way that I think would have been hard to predict pre-pandemic. And therefore there are growth opportunities for companies like Amazon, for Netflix, for Alphabet, which is the parent of Google, that are probably different to traditional businesses like an IBM or a General Motors, for example. The difficulty is that the way in which the market has been valuing those shares is extraordinary, and it's never better illustrated by what's happening to Tesla. Now, the prospects for Tesla are very exciting. It's got a great position as an electric vehicle maker, but in terms of conventional analysis of valuation, it's off the charts. It's off the charts where we currently stand today, and the type of growth that Tesla would have to be able to exhibit to recompense the valuation that the shares have been sitting on would be really, really extraordinary. Not impossible, but really extraordinary. And I think that's why one's got to be slightly careful of not getting overcome with excitement about the opportunities in the FANGs, but being careful, analytical and objective about what the prospects are for those companies.
Okay, thank you. Just with regards to moving on to commercial property and where you see that going for the next few years, obviously we've got the issue of a lot of people, employees aren't necessarily back at work at the moment. A lot of them are working from home, obviously. Some banks have even said that they'll not have their employees come back potentially until 2021 even. So how do you see that affecting landlords, and how do you see that affecting property funds, commercial property funds particularly in general?
I think it's still too early to tell, really. And we're sitting here at the beginning of September. I think we will have a clearer picture as we get towards the end of the year, because people have only just been coming back from holiday. I was talking to a couple of colleagues here in our Lombard Street office about the amount of people they're seeing around the city, and even over the past couple of weeks the numbers have increased quite considerably. Now, we're nowhere near capacity, and there's huge problems for the transport system, but for a commercial property fund, I think it would be foolhardy to say that the world has completely changed, that people will not return to offices. Yes, there will be a different way of working going forward, I'm sure that is the case, but for companies, for landlords that are progressive in the way in which they think and can demonstrate they've got flexibility in the use of the space, then there's no reason why they shouldn't do quite well going forward. Within that, I think there's some sectors that will be quite important to watch. So in-town shopping centres that are quite dependent on a mix of business and tourist and conventional shopping, that might be harder going than, for example, out of town, where there's more space, people can travel to more easily. Offices in the centre of town may take a bit of adaptation. Maybe there a different mix of use for offices going forward. But on the other hand, if you look at the retail warehouses, there's going to be huge demand for those going forward, because they will need to not only fulfil the current requirements of e-retailing, but the future requirements, which are definitely going to grow from here.
Brilliant, thanks for that, Chris. Just moving back on to your role as global strategist within St James's Place, how do the fund managers control their stock and sector weightings, and why is this important for clients in general?
Well, if you talk to a fund manager, if a fund manager was sitting in the chair that I'm sitting, they would say that the way in which they think about building portfolios is to say what is the value they're seeing in the companies in which they invest, and that therefore the sector and country weights, if it's a global portfolio, tend to be a function of the output of that underlying valuation in the companies. So they really generally don't make bets on what sectors they want to follow or what countries they want to follow. So what we don't want to do from our perspective at St James's Place is say, well, Chris has a really strong view on China and therefore you must own more shares in China. If they don't see the value in the companies that they want to invest in China, then they shouldn't be obligated to invest in those. And it's definitely been proven over time that trying to take those short-term or even medium-term asset allocation decisions to be overweight in an asset class like equities or overweight in an asset class in a region like UK equities has been really difficult to get right, and therefore the process that we have of saying, well, let's have underlying portfolio managers choosing really good companies and then build those into diversified portfolios is, I still think, absolutely the best way to run money for our clients going forward.
Okay, and with regards to coming on, sticking with fund management, in terms of the income reductions we've seen on dividends with certain companies across the UK and abroad, of course, how has that altered our view of income investing as a company and as a fund management group?
Well, I think it's been most pertinent in the UK. So if you look at the US or Europe, the payment of dividends is not so culturally inbuilt, let me put it that way. It's really a UK phenomenon. Right. Yes, there have been dividend cuts. There's been dividends which have been postponed. There's been dividends that have been passed, which is hardly surprising considering the gap in earnings that companies have seen during 2020. But many are now thinking about reinstating their dividends and thinking about the timetable for that. Having said that, I don't disagree with the theory that there has been some structural change in dividend payment. That, for example, a company like Shell, which cut its dividend quite substantially earlier in the year, is looking at the amount that it needs to pay out in dividends, which I think is about $7 billion a year. It's an extraordinarily large figure, and saying, well, is there a better use that we can put to some of that capital in terms of reinvesting in the business, particularly for an energy company that's clearly got to change over the next period of time. Now, if that's the case, then dividend returns, income returns, could be lower going forward. I've always looked at it from the perspective of saying, well, we need to look at the total return, so capital plus income. And if we can create a good total return from an investment opportunity that is better than just the dividend return, then that's the type of company that I think our clients should be investing in. So I think actually having too much focus on dividends isn't necessarily going to be the best thing for a client to be focused on. They need to be thinking about, well, how can a portfolio of shares deliver me a good total return?
Thanks, Chris, for that. Just sticking with the subject of fund managers, there's been a lot of talk in the press, obviously on the internet as well, on lots of blogs, etc., about value managers and where they fit in now, and they seem to be, in some commentators' opinions, out of favour. Where do you see their role going forward, and do you feel they'll come back into vogue again as a fund manager?
Well, they're certainly out of favour. Value has had a spectacularly poor run for a number of years now. But I think, for me, and I'm naturally, instinctively a contrarian, the more people say value is dead, it no longer works as an investment strategy, and it's sort of encapsulated by saying Warren Buffett has lost it, you shouldn't be giving your money to Berkshire Hathaway, the more it makes me think that we will see a bounce back.
Yeah.
Now, I have no idea when that's going to happen. I think it's really, really difficult to pick what the catalyst for that change will be. But obviously, in a market where, as we've been discussing earlier, the technology stocks, the FANG stocks have been performing, and they are definitely growth rather than value. And the momentum in those stocks has been so extraordinary, it's been really hard for value to perform. I still think value is a very... Let me start that again. I still think value is an absolutely legitimate investment strategy. I still like managers who adopt an approach of saying, well, I want to find really high quality companies that are cheap, rather than buying into companies that are growing incredibly fast, where the share prices are reflect a very expensive valuation. And I think there will be some mean reversion of that going forward.
Thank you, Chris. Great answer to that one. Who have you actually enjoyed interviewing the most, either in your career in totality or more recently?
Well, I've been astonishingly privileged with some of the people that I've met over the years of my career. I suppose the highlights are two or threefold. Firstly, I had the very good fortune to have a one-to-one breakfast with Larry Fink, who's the chairman and chief executive of BlackRock, who are the largest fund management company in the world. And we sort of chatted about what was going on in the world for an hour and a half, and just hearing his insight. He's an inveterate name dropper, so he was dropping the names of the Treasury Secretary and the Chair of the Federal Reserve and various other very important finance people that he was meeting on a regular basis. But I felt immensely privileged to be spending time with him. I think the most interesting recent interview that I did was with Jeremy Grantham, who works for GMO. Okay. He is a fascinating individual, very thoughtful about what's going on in markets, and has written extensively about it over 40 plus years, but extremely focused on climate change at the current time. And I think it is his vision about how the world needs to change, and the way in which he himself is committing to do that through his own foundation. I found that incredibly powerful.
Right, okay, brilliant. Yeah, it sounds like you've interviewed some good people over time. One thing that be interesting to get your views on, and it's something we get huge amount, as you can imagine, of inquiries into the company at Ryley Wealth Management, is people asking, particularly in times like this where there's some form of crisis, whether it was 2008 or now with the coronavirus, is should a client be going defensive with their portfolio, in your view?
Well, I think it's really difficult to suggest to a client when markets are turbulent that you've got to stick with what you're doing. It's a very hard message to convey, and I completely understand how challenging it is for a client who is looking at what's going on in markets and thinking, well, actually, I need to be getting some security, maybe even in cash. But actually, the time that one needs to some extent be reinvesting more is when markets are going through periods of volatility. So it's actually putting more money in the areas of the market that have fallen rather than the areas of markets that have been more resilient, which is sort of slightly contrarian, slightly contradictory to what the type of behaviour that one would ordinarily imagine. I think that is where the role of David, you and your colleagues at Ryley Wealth Management can really help clients, because it provides an engagement with them to help them understand what the world looks like. It gives them opportunity to link into what we're writing about at St James's Place, the videos, the podcasts that we do, that I hope are helpful and reassuring messages that changing an investment strategy when there is so much change going on around one is probably an unwise move, and that actually sticking to the focus on the longer term, reminding oneself of what one's goals are, what one's attitude to risk is, should not be swayed by short-term market movements.
Lovely, thanks for that, Chris. That's a good explanation. With regards to the penultimate question I've got to give you, we get a lot of queries about gold as a defensive asset class, and in general, is gold a good thing to go into in times like this? So what would you say to people with regards to your views on gold?
Well, it's fascinating, because the reason that I think a lot of people are talking about gold is because it's got to an all-time high.
Yeah,
it's an investment that has performed very, very well over the past period of time. But if you would ask me how I'd value gold, I have no idea. It's impossible to value gold properly, because there is no income that it derives. It does not have a value in the way that an equity or bond has. So I think it's very hard to say whether the current price of around $1,900 an ounce is the right price. Now, is it the type of asset that one wants to be in a time of change, in a time of uncertainty? I can see why people have said that, because it appears to have done that in the past. But actually, if you look at the analysis on it, gold hasn't actually been a good store of value in difficult market circumstances over an extended period of time. You can take the data back 100 years. So I'm not persuaded that gold is necessarily a good hedge against market turbulence. The other thing is that gold is difficult to invest in. You don't want to hold physical gold because there's the practicalities of storing it, and the ways of holding it in a derivative structure are relatively inefficient. So I have always thought that there were better alternatives to gold, whether it is some of the alternative strategies that we have at St James's Place that I think are quite defensive, quite resilient, or whether it is the diversified portfolio that I've talked about quite a lot already this morning, that really that is a way of achieving that hedge against market movement, and should give clients a sort of sleep at night feeling that I don't think gold necessarily gives you.
No, well, thanks for that interesting synopsis on gold. So your final question today, Chris, is what keeps you awake at night?
Well, it's a difficult one to answer. I generally sleep reasonably soundly. I suppose the thing that really keeps me awake at night is climate change, right, and how we respond to it. I think the pandemic has been a wake-up call that there are big things happening out there that we need to respond to, and climate change, to my mind, is a huge issue for the world, and I'm terrified by governments that are recalcitrant about not wanting to engage their economies in making that change. For example, still producing power by coal. I mean, it's abhorrent in the 21st century. And sort of added to that, what the world looks like for our children. I've got 3 children in their 20s, and they are worried about their job prospects. They're worried about what type of world they're going to live in. I know of a number of young people who are saying that they don't want to have children. I mean, that's a terrible, terrible indictment of our society, that we can't develop because of the world that we've been fortunate enough to live in, and the one that we're passing on to the next generation. So the time to act is today. We've got to make changes. to preserve the climate going forward and indeed improve it. That would certainly make me sleep better at night if we were to take some real progress on that over the next couple of years.
Lovely. Thanks very much, Chris. Thanks for your time today, and I'll certainly look forward to interviewing again at some point in the near future, hopefully in better climes and less challenging ones as well.
I'll be delighted to do that, David. Thank you so much for your time.
Thank you, Chris.